Distressed real estate, which is conscious it comes in very different shapes and sizes depending on which pocket of capital you represent or you're focused on. Without sounding like a lecturer in any way, I think distress in our world is somewhat different to what we're seeing in the normal corporate world. My corporate colleague on the corporate finance desk that have the pleasure of selling corporate businesses that are living and breathing do face what I call proper distress, i.e. if they don't sell a business by tomorrow, the suppliers may walk and the shops may close. In our world, I think we describe distress somewhat differently. I think if we don't sell a bunch of properties tomorrow, chances are it'll still be there. So we're facing, I think, a slightly different landscape, and I think that drives a slightly different dynamic in terms of who can play in the distressed real estate space relative to the corporate real estate space. So I think what we call distress, and I'll be interested for other views on this, is frankly over-levered properties or under-invested properties. There's quite a lot of those out there, but there is also quite a lot of very good properties that are locked into bad capital structure. And I think the fact that there are very good properties in there means that you see the likes of the UK pension funds playing in some of this and bidding for what could otherwise be called distressed. Just another point to touch on before we start going into where are the main sources of these opportunities is a kind of two products. I know it sounds obvious that you can associate with this quote-unquote distressed real estate. Clearly, you can buy properties out of it, surprise, surprise, so brick and mortar or shares in propcos. That's all fine. But I think you'll all have noticed over the last sort of 2 years now in the UK that real estate loans are certainly one of the key products that people are looking at to buy into this market, whether that's sort of straight loan-to-own strategies or frankly just buying loan pool for yields. And I think that's an interesting theme we need to come back to. So very quickly, the 4 pools I'll touch on, and it is very much an overview. We'll talk about the banks and what comes out of there and what's the scale of the opportunity. We'll talk a little bit about the CMBS market, what comes out of there in terms of properties. Over-levered borrowers, which is another side of the coin, and insolvency, though I won't dwell on that because I'm conscious David will talk about this in a lot more depth in the second part of the presentation. So if we start with banks, I haven't checked the latest sort of demand for stat on this, but the one I remember is this broadly 220 billion of debt secured on the UK real estate market. Clearly, if you look at Europe, it's much greater. Sort of the back of the envelope calculation I made on this is, I think it states quite clearly that 10% of this 220 billion is properly either defaulted or LTV in excess of 100%. So call it 20 odd billion, which is sort of straight, I think, distressed in the purest sense of the definition. And probably another sort of 60 odd billion, which has got LTVs in excess of 70 or 75%, i.e. some situations where, frankly, you could do with an element of recapitalization. It could be a small amount of recapitalization or that the borrower can pump in money, but I'd put that in the bucket of situations where an external capital provider could bring value to the incumbent borrower. So you're looking at 90 billion, very big pool. I think the opportunities coming out of this, to keep it simple, are there is a steady flow of asset sale where borrowers get asked in the nicest possible way or not by the banks to sell assets. If you can get in there first or if you can provide money to prevent that, clearly there are opportunities in there. It could be pushing towards insolvency, we'll come back to that. And it could just be, frankly, a number of banks that are pulling out of their old customers. So we all know, the Irish banks are not exactly playing in the UK market at the moment or in Europe. So new, even senior lenders can see opportunities coming out of those. The second stream, which I touched on at the beginning, is around these loan sales, which the Financial Times and the rest of the property press get really excited about. We did a little survey at the beginning of the year, and I think as at January, we'd seen about 8 billion of loan balances that transacted in the UK. That's probably increased since I think Project Thames is all about, or almost closed as far as I know. And that also excludes single loans. But there is quite a lot coming out of there where banks, frankly, we think of, on the whole, lost patience, are recognizing that it takes an awful lot of manpower to work out these loans loan by loan. They perhaps now have got a balance sheet that enables them to transact this way, and therefore are forcing through big buckets of loans to try and achieve their deleveraging target. There are various strategies within that, but the truth is it is quite a big theme coming out, and I think you've seen also, frankly, other organizations taking even more drastic decisions of selling entire bank subsidiaries. So, Euro-IPO is a well-known case. There were references in the press recently of Postbank maybe put on the block. So there's quite a lot out there on the performing and non-performing side. Moving on, CMBS, I think we all know that it's perhaps not as liquid as it once was, be it it's improved significantly over the last few months. I'm just talking here about, frankly, the legacy CMBS positions. It's quite an easy market to track, quite a lot of information in the public domain. We can, on the whole, see what properties are sitting underneath some of these either sort of issuer-focused or conduit structures. I think it's effectively a subset of what we're seeing in the bank market. I think it's a lot smaller. You're talking about 50 billion sterling, roughly, I think, in outstanding terms. Most of the situations, frankly, mainly because of the servicing standard that the organization that manages these structures are subject to, sort of constrain them somewhat into what they can do and how creative they can be. In our experience, it has meant that a lot of the services just end up selling assets, either forcing the borrower to do so or putting them into insolvency processes. I think that creates a steady flow of opportunities. A lot of people associate CMBS with, very shiny office buildings in the city. The truth is, they're not as many as people think there are. There is a lot of conduit out there with, frankly, 50 million euros loan backed on quite secondary European properties. Not all of it will go, or is unlikely to go to, I think, some of the bigger players that are represented here. Quite a lot of it end up going in the retail market. If you look at, I think, a case that's on DebtWire pretty much every day, which is a Mozart loan coming out of the Talisman 7 structure. They sell, 2 million, 3 million properties, 2 million worth of properties pretty much every week. So it's very small and granular, but there's a lot of it coming out. One theme which I wanted to pick up on, because it's not all about asset sale, is some of the recapitalization of the bigger structures. So case studies are the likes of Uni Invest in Holland, which Patron Capital and TPG took control of. I think Opera CMH was in the press recently, yesterday, day before. So whilst asset sale, I think, is the main route for exit, this is not the only one. And everyone has put their sinking capital to try and make sure they find more holistic solutions. I think it works in situations where it's kind of a single issuer focused on one portfolio. As soon as it becomes conduit, and I would be happy to be proven wrong, I haven't seen situations like that as yet. But as I said, it may just be me. Moving on, borrowers, the other side of the coin, but I do think it's a really interesting one. So effectively, banks and CMBS, we can all go and trot along to NAMA, Lloyds, RBS, and all the services to say, do you have anything to sell? The truth is, most of these situations are obviously locked into sort of private property companies. It's a very difficult market to track, or at least we're finding it quite challenging. So it's all about scratching your head, trying to remember who did what deal and how well it went, which is that little bit more challenging. When we've been able to do it, effectively you're aligning yourselves to a special purchaser. We find the information asymmetry between the lender and the borrowers is typically quite significant. And the security position of the lenders is not always as strong as it first appears. Ergo, if you can find yourself in situations where you can back the borrower to buy their debt back at a discount or table an offer one way or another, we found that we get an audience for the banks much more than if you just approach them separately and say, would you sell your loan to us? So quite a murky market, but we think that's a very interesting space, and the solutions coming out of that are very, very varied, but there is quite a lot of it coming out. Last but not least, insolvencies. I think it's a very public face of distress. insolvency equal distress seems to be the approach most people are taking. I don't think, for the reasons I explained, in terms of what does distress mean in real estate, is as true as people think. I've had the pleasure of being on the other side of the phone of buyers saying, well, your firm has been appointed as administrator, you've been appointed to sell it. If you don't sell it tomorrow, then it's going to be disaster. The truth is, well, it's not. And frankly, I've been very surprised as to the level of interest we've had in some of these insolvency situations. Arguably, I think in some of the higher profile cases, I'm not sure we would have had as much interest if it wasn't for the insolvency process. I know it sounds ironic because everyone expects a big insolvency discount associated with this distress, but I don't think it stands, certainly for some of the better kit. And frankly, the situation out of there is not that creative. It just ends up being a good old asset sale, corporate sale sometimes, but frankly, the lack of reps and warranties means that there's not as much appetite for this as there otherwise could be. Now, just to close off, we get asked very frequently, sort of, why are we not seeing more deals? And yes, I've read the demand for survey, and it says 200 billion, and I haven't seen 200 billion transacting. Sometimes the question is a bit more subtle than that, but that's broadly the theme. We've talked about some of the forces that are pushing the deals. The banks generally want to get out. The CMBS is coming to maturity. I think, interestingly, quite a lot of foreign banks want to go back to their core markets. All of that is sort of pushing deal flow. It's never enough, but it's pushing in the right direction. In terms of the forces that are pushing against it, albeit I think it is improving, just to pick up on a couple, because I think none of them in isolation are a massive blocker, but swap mark-to-markets, really big problem. I know we're getting into the weeds of the technicalities, but a number of, frankly, some of the big situations we look at have the pleasure of long-dated or rather complex swap structures, which means that you end up having mark-to-market liabilities in excess of 100 million. Frankly, you look at this and you're a lender and you say, well, if I believe the yield curve, which is a big if, that liability will fall away at some point. Now, this theory has been proven wrong many times, but there is some truth in it that when the swap expires, the mark-to-market will go away. And that has generally, in the conversation we're having with these lenders, just blocked transactions from happening. That belief, which I think is a fair one, is frankly, if I've got 2 years to run my swap and 50 million mark-to-market, I just sell it for 2 years. Unless you can prove to me that the value of the property or my collateral, whatever that may be, ends up deteriorating by more than 50 million quid over the next 2 years, which in most cases is a bit of a stretch to explain. And I'm conscious it is a bit more focused mainly about the UK, but there are sort of European angles to this conversation. I think the other one we're seeing, especially in Southern Europe, is as much as everyone can identify the over-leveraged positions and the banks are not exactly in a healthy shape in a number of Southern European countries, the truth is the insolvency regimes in these countries is not exactly creditor-friendly. So even if the banks had the ability to absorb the losses, even if, the law is such that it's really difficult for them to pull the trigger and get their money back.